You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cashflow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here. I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is real estate expert Michael Finch. Now, Michael began his career in commercial real estate over 16 years ago and quickly developed broad local and national relationships with the top-ranked high-density mid to large-scale developers for commercial mixed-use and multifamily developments. Now, as the markets shifted following the Great Recession in 2008, Michael leveraged his relationships and founded SFRhub Advisors, which is the leading SVN commercial real estate brokerage focused on single-family rental portfolios and build-for-rent investment portfolios. Michael is also a founding partner in SFRhub.com, a digital marketplace for buyers and sellers of single-family residences and build-for-rental investment portfolios. And so, as all you guys are probably already aware, our show tends to steer clear of talk related to single-family investment. It's solely focused on commercial real estate investing. That's what we're all about here. However, Michael's focus is on large portfolio transactions, which very much fall into the commercial realm as far as real estate investments are concerned. And so it's a very fitting talk for today. As you'll see during our conversation, Michael has transacted some incredibly large portfolios over his time in his business. And so I think it's going to be very in line to what you folks are looking for and really might fit in as a way for you to diversify your current commercial real estate investments. And so, guys, with that, I'm excited to get onto the show with Michael. But before we do, just have a few quick housekeeping items I'd like to run through. First and foremost, if this is the first time that you're tuning into the show, I just want to welcome you here to our family at the Real Estate Investing for Cashflow podcast. And if you're one of the many millions of loyal listeners that tune into our show each and every week and month, just want to welcome you back and thank you really from the bottom of my heart for joining us here each and every week. We wouldn't be here if it wasn't for you. And for that, I'm truly grateful. Since it's really folks just like you, loyal listeners that tune in each and every week that make this all possible, I'd like to give a shout out like I do every week to one of our listeners who took the time to leave the review up on iTunes. This review is from Dave Olson 36. And Dave says, Kevin's podcasts are very informative and provide great value to any investor. He covers a multitude of investments like self-storage, mobile home parks, RV parks, and the typical topics like apartments and housing, etc. I can promise you, regardless of what your business idea or investment plan is, the value can be found from Kevin. So, Dave, I really want to thank you for taking the time to leave that review. And folks, if you love what we're doing here, please take a minute, subscribe to the show first and foremost. Make sure you subscribe so you get all the latest episodes when they come out. And if you're so inclined, leave us a 5-star rating and review on iTunes, and I'll be sure to give you a shout out on an up-and-coming episode. Just so you know, these reviews really it's not really an ego-driven thing by any means. In fact, it really helps us drive both the ratings, but also the quality of guests that we can attract here to the show. So it's very important. It's very vital to the continuation of us attracting awesome guests like Michael here. So please, again, it takes just a few minutes. Go over to iTunes, leave that review and rating. And one other quick thing before we get rolling here, just want to remind you of the free 30-minute phone consultation that I offer. Each and every Friday, I have 4 different 30-minute time slots that I make available for you and I to connect on the phone, okay? This is a way for you to discuss with me anything your heart desires regarding real estate investing. There's no ulterior motive here. I'm not going to try to pitch you or sell you on anything. It's truly my way of giving back and my way of connecting with this awesome audience that we have built here. Doesn't matter if you're brand new to the business or if you're a seasoned investor. I'd love to get on the phone and help you out or just talk shop. Again, if you're seasoned, and you might know more than I do, right? I don't know everything. And either way, I'd love to connect with you. One catch. There is one catch. We do record these calls, okay? And more than likely, we'll be using them as future content here for our podcast. But I will tell you this. Most of the questions that I get asked are questions that tens of thousands of others are having, or challenges that those folks are having, that many people have. And so think of this as a way of you and I kind of teaming up together and basically helping the tens of thousands of others out there that are probably experiencing the same exact challenges that you might be facing, okay? If you want to schedule that call with me, go to my website, kevinbupp.com. There's a button on the right-hand side about 3/4 of the way down. It says schedule a call with Kevin. Click that. It'll take you to a calendar link. just make sure that you put some details in there of exactly what you'd like to chat about during our 30 minutes together. And then I'll look forward to connecting with you. Now, guys, without further ado, I'd like to welcome our guest for today's show, Michael Finch. Michael, how you doing today, my friend?
I'm doing well, Kevin. Thank you.
Yeah, thanks for joining me. I know you're super busy out there transacting all these crazy large single-family home portfolios, but you've taken an hour out of your day here to join us here, and I'm very much looking forward to understanding a little bit more about you and your business, and ultimately how you fell into this niche here. So maybe if you could, I give you a little bit of a background. Surely that was a very condensed version of it. So maybe take a few minutes, give our listeners a little bit more of a background of who Michael Finch is, and ultimately how you fell into this space.
Sure. Well, I've been in commercial real estate for 16 years, as you had mentioned. And again, my background was primarily, pre-recession heavy into multifamily and mixed-use land for, regional and national developers. I've worked with all the large multifamily groups around the country. And then, post-recession, there was no land transacting specifically in Arizona in the Southwest for many, many years. So I moved into the existing multifamily side of things and sold a number of multifamily properties, from 2010 to 2014. And, land came back a bit and was working with some of the institutional developers again, too, on the multifamily side. And then in 2015, I have a partner, Jeff Klein. Him and I had been working together for a number of years at that point. And we had kind of stumbled across a 55-home single-family portfolio here in Phoenix. And it was, really happenstance. It was another local broker who brought it over to me because we were somewhat involved. I was somewhat involved in some note sales in the past, working with banks, selling portfolios, but hadn't actually played in this single-family investment space from a traditional standpoint. And, we looked at the data tape. We started doing some underwriting. We realized that there were no other commercial brokerage houses playing in the space or any commercial brokers in general. And it was a lot of realtors and fix and flippers and wholesalers. And, at this point, the institutional guys like American Homes for Rent and Colony Starwood and Invitation Homes, they had been around for a few years now, the Progresses of the world. But there wasn't a commercial brokerage that was really focused on that. So anyhow, we got that tape sold. It was an $8 million portfolio of 55 homes, and we ended up getting it transacted in about 60 days. And we kind of looked at each other and we're like, wow, there's nobody else that we know is doing this. And we need to bring this up to more of an institutional quality commercial real estate asset class and market it like we would any of our multifamily deals. And we didn't see anyone in the country doing it. So we got that first deal done and started, and that was in Phoenix. And we were a part of SVN at the time, Sperry Van Ness. And we just started putting a program and a platform behind it. And we started doing more deals, and we got very good at underwriting the deals and, really cleaning and verifying the data, which we also recognized was lacking in this space because most people just used the MLS or Zillow, which didn't actually clean or verify any data. You're just relying on realtors to put in the correct information. Oftentimes the MLS was wrong on bedroom counts and Zillow was wrong on square footage or whatever that might be, because no one was actually cleaning and verifying all the data on every single home in a portfolio. So fast forward 2016, 2017, Jeff and I had purchased an SVN franchise, SVN being Sperry Van Ness, the 6th largest commercial brokerage house in the country. SVN is all independently owned and operated. So we were unique in that we were really putting a platform together for the single family investment portfolio world. And being that we were the only commercial brokerage in the country doing this, SVN Corporate gave our franchise the entire country as our primary market, which usually when you own an SVN franchise, you play kind of within your MSA. But because we were so unique and niche and specialized, we were given the entire country as our primary market so we can work with local SVN offices all over the country and transact in all 50 states if we need to. And on the other side of our company, so Jeff and I own SVN, SFRhub Advisors, that's our brokerage. we also recognize a need to make the process a bit more efficient, both from a data and underwriting side as well as a transaction side. So we started SFRhub.com, and we partnered with another gentleman named Dale Jensen, and he comes from a 30-year tech background. And we spent a couple of years, raised money, spent a lot of our own money, and worked with him. And he really just watched how we would go through, how we would analyze tapes, and he put together a digital platform to really help automate and make the underwriting more efficient and more useful, so we could, analyze 30 portfolios a month and do it quickly, as opposed to, 3 or 4 a month, because we were picking up a lot of steam on a national level. And so through Dale's help and partnership, we launched SFRhub.com at the last single family investment conference in December, the IMN SFR investment conference, which is the largest single family investment conference in the country. Those are a biannual conference, and we're the lead sponsor every year of those conferences. And we launched our tech platform this past December. And since then, we have loaded up almost $1 billion worth of inventory on that site today of single family investment homes and build for rent investment homes. So that's a very high level view of our two companies here. The SFRhub.com platform, it's really a data evaluation and technology platform for transacting portfolios of homes. And that platform powers our SVN platform.
Very, very interesting. Well, that's quite impressive what you guys have been able to accomplish over such a short period of time. I mean, really, we're talking about 4 years or less than 4 years. So very, very impressive. What do these portfolios typically consist of? Are they REO properties? Are these, fully functioning, occupied rentals that are being bashed up and sold? Are they first lien notes? I'm sure it's a mixture of all the above, but generally speaking, what are you seeing today? What do those portfolios consist of?
We see lots of the REOs today, of course, just like you would in any asset class. Most of what we see today on the existing portfolio side, and we really have two divisions here at SFRhub. One is on build for rent new construction homes, and then the other is the existing single family portfolio homes. Those tend to be scattered around in MSA or multiple states, depending on the size of the package. But on the existing side, we tend to see, and it's a wide variety, no different than multifamily, where you've got, C class, B class, A class homes. Sometimes a whole portfolio is all C class homes. Maybe it's, you got 100 homes and that particular buyer, or I should say seller, but the gentleman or lady who aggregated that portfolio, they may have targeted a certain asset class of homes where, maybe they only bought 1970s and older homes. So, they like the lower, kind of class, so to speak, just like buying a C-class apartment building. Typically the buyers of a C-class apartment building tend to stay in the C-class world because that's what they know, that's what they operate, that's what they prefer to manage. And then sometimes a portfolio will have A, B, and C-class homes. Sometimes it'll be all relatively new homes like 2005 and newer, more A minus portfolio. So it really ranges, but by and large, most of them are typically fully leased or near fully leased. You could use and argue the word stabilized in that, they're typically fully leased, but a lot of times what we see is the value add in a single family existing portfolio is the buyer has the opportunity to take the rents up, usually pretty dramatically, because unlike multifamily apartments where the tenant turnover is pretty heavy and you're constantly every, year, 15 months, you're turning over a unit, you're getting it up to market rents. In the single family world, the tenants stay for quite a bit longer. So especially in the mom and pop operators of the world, they tend to not push the rents as much as maybe an institutional company would be on top of their property manager and asset manage. There are PM companies where the mom and pops historically, we've noticed that the existing portfolios are anywhere from 10 to 30% under market rents. So when we get a portfolio, we look at where they're operating. If it's 50 homes in Atlanta maybe the average rent is $1,300 a month, but the average market rent for, those homes might be $1,450 a month. And that's the opportunity for the buyer to come in, push the rents on the tenants. Oftentimes, again, the tenants, are willing to pay more because it's more expensive to move out of a 4-bedroom home and try to find something, in the same neighborhood where your kids go to school, where your job is at. Unlike a multifamily apartment building, there's one every few blocks, and those tenants can just pack up and move pretty quickly. But it's not the case when you're living in a single family home.
Yeah, very interesting. How about the evaluation side of these different portfolios? I mean, obviously you guys, you didn't create the space, but you were one of the first folks that truly came together and said, hey, like there's a missing opportunity here. There's really no sophisticated platform to date that, to where these portfolios have a streamlined, efficient way to market to the world. And so, comparing it to multifamilies, I think that's the closest, example to use. Any different MSA throughout the country, there's a ton of data already as far as sales are concerned, as far as cap rates based on quality of that asset. I mean, again, lots of existing data that appraisers and brokers like yourself can use to underwrite these deals. Very different,
Correct.
Right? When you guys are jumping into this unknown space, especially when you got portfolios that have, a couple properties here in this county, a couple properties in that county, a C grade here, a B grade there. I mean, you got all this intermingling going on. So give me an idea of how you guys manage that, or how you managed it back then, and ultimately how that's evolved over the last couple of years.
Yeah, good question. And, from a commercial investor standpoint, commercial brokers, commercial investors, they've, almost solely relied on CoStar. And then there's, Real Capital Analytics is great. And, there's a couple others out there, but primarily CoStar is the 800-pound gorilla in the room. And everyone, whether it's an office building, an industrial building, a hotel, multifamily, you go to CoStar and they've kind of tracked everything from the get-go. There hasn't been something that consolidated in the single family investment space. And it was something that we recognized pretty quickly, and which is why we were excited about the technology platform that we launched at SFRhub.com, because, every portfolio that comes into our system, not only are we analyzing it from a valuation standpoint, we utilize the number one AVM in the country, that's automated valuation model. And that's, compared to the top 30 AVMs in the country. According to the Mortgage Bankers Association, we've been number one 2 years running now in our valuation. But what we do that takes it even a step further is we pull in multiple data sources. We've built in some AI in our background to red flag discrepancies. So, we run, if we get a 100 home portfolio of homes, we go about 25 to 35 checkpoints on each home. So we're checking that the address is correct. We're checking that the square footage is correct, the bed bath count, so on and so forth are all correct. And we're pulling in multiple data sources, that, whether it's Zillow or the MLS and public records or title or whatever. So if everything shows up consistent, then we're pretty confident that we have a clean and verified data file on that one house. If there's a discrepancy and 3 sites say it's a 3-bed, 2-bath, and one says it's a 4, for example, that's a red flag. And then we have our human capital dig in a little bit deeper. So then they're going to call the seller. They're going to look at public records. They're going to call a title company. They're going to, is it a 4th bed? Was it a garage that wasn't permitted into a bedroom? That's the kind of detail that we start getting into to clean and verify the data on each of the homes in the portfolio. And then we run, as we're cleaning and verifying that data, we're also running it through the AVM to put a valuation on it, on what that home would sell for, today on the market. And we're about 3.5% off the true value of any home in a portfolio. And then, we'll take it a step further and put a retail portfolio price, on all 100 homes to be sold in bulk. So that's how we start establishing our values. But then because of our investment background, then we start putting the projections and the rental market data together. So we know where the seller is currently at. He's got these rents or she's got these rents, and they're operating at, this, operating expense ratio, depending on, are they managing themselves? Do they use third-party management? What's their typical repair and maintenance? Just like you do in multifamily, it's most of everything is similar in that regard. You got your repairs and maintenance, property management, taxes, insurance. Sometimes you'll have HOAs if the homes are in HOAs. We don't get heavy into CapEx because every operator is different. So just like multifamily, I never guessed what somebody would put in CapEx wise, but the standard expenses for operating a investment portfolio go into that. So we'll look at where the rents are, where the rents could be, because as I mentioned, typically the mom and pops or even larger institutional groups, they still tend to be under market rents. Just it's the nature of the single family world where tenants stay typically quite a bit longer. So it's you want to stay on top of pushing those rents, but at the same time you want to keep the tenants in place. So if the rent in a submarket grew 5% year over year, maybe you're getting a 3% or 2.5% rent bump, with that tenant to keep them in there instead of really pushing it to 5, year over year. So you kind of lag behind, but that's the opportunity for the next buyer to come in and maybe not, quote unquote, be the bad guy and turn those units and get everything up to market rents and get it cash flowing at a pace that it should be.
Got it. Do you find that typically these units carry more value? I mean, when you're dissecting a portfolio, and again, I know that this might be a loaded question, but do you find that they carry more value, generally speaking, from an income valuation versus a comparative sales approach, which a typical resident occupied or owner occupied home would use to do a valuation? Which comes in higher?
It's a good question, and it's really. Unless it's a very large portfolio, I mean, you need to get into the 500 to 1,000, plus home portfolio where maybe the cash flow is taken more into account than the actual values of each individual home. Mm-hmm. But in most cases, buyers, let's say it's a 100 or a 50 home portfolio or 10 home portfolio, anything that's a little more reasonable that a typical high net worth investor would look at, they're going to take both into account. So it's really, most don't typically want to pay over retail value to buy cash flow. So if, the home is worth $150,000 retail and it's a 6.5 cap, you're probably not going to get someone to pay $155,000 for the home just because it's still a 6.48 cap. Yeah. They're gonna want to take both into account. So it's kind of it's a delicate balancing act, and it's a little bit different in regards to any other commercial asset class because it's both. Where is the value of the home? Because maybe I want to, maybe I'm going to buy this 50 home portfolio, but maybe these 20 I'm definitely going to renovate because this area of the MSA has appreciated or will be appreciating more than a different area where some of the other homes are in. So, an investor might look at buying portfolios in unique ways where some homes might be more prime to put in some money and then flip them out on the open market to a retail end consumer. Other ones might be better to hold for cash flow, or, you just buy the whole thing for cash flow. But by and large, you want to, most people expect some sort of a discount for buying in bulk. No different than if someone was buying 10 apartment complexes from one seller, that seller could probably sell them individually at a little bit higher price than, selling them in bulk. Right, but, by and large, nobody wants to pay more than retail for cash flow.
Okay. Well, I asked the question only because I've got, I know a lot of folks, the turnkey space, the single family turnkey space, not on a portfolio side, but individual single family properties, lots of companies out there. That's obviously a business model that kind of arose from the ashes of the Great Recession. Maybe it was around that, but I don't recall ever hearing too much about turnkey single family investment opportunities. And it's always been the question I've had with a lot of those providers. And I know a number of, great guys that own and operate turnkey companies, but a lot of the properties that transact are being sold on a cap rate, being sold from an income valuation standpoint, and they're being sold for cash. And so there's not really a traditional appraisal process involved. Mm-hmm. And seeing some of these things, I question, are they being sold at a higher price point than ultimately what that would have sold for, as an owner occupied unit? And it's just, I've seen some of the cases where that, that be the actual issue that's playing out. And it just seemed risky in some situations. Anyway, I don't want to go down that rabbit hole. That's a completely different conversation, but
I think, that's happened, when especially if somebody's got a 1031 and they're going to buy a turnkey portfolio, which we have some portfolios that are arguably turnkey right now, where an investor, took $25K, put in the exact same upgrades in every single home, spent a year doing that, re-tenanted every home. So you got brand new flooring, cabinetry, appliances, all the big ticket items are taken care of, and you got new tenants in place, and it's just a turnkey, coupon clipper type of portfolio. That's a 7 cap and will be, fairly easy to manage, and maybe the right buyer, because he's got 1031 is willing to pay, a little bit more just to get that cash flow. But as I said, by and large, people take both into account when looking at, purchasing single family portfolios.
Okay. What kind of financing is available for these portfolios? I'm assuming, I'm not going to assume anything. I'm just going to ask the question, wait for your answer.
Yeah. On the existing side, and we haven't talked about build for rent, which is a whole other topic, and we can get into that too, because it's got certain advantages over all commercial real estate asset classes. And I think single family in general does as well. But from a financing side, tons of lenders out there that are playing in the space that are doing billions and billions of dollars a year in single family portfolio investment financing. Also, a lot of times local banks will put, good terms and rates on portfolios in their community. Really just depends. But we work a lot with, 5 Arch and Corvest and Lima Capital, and SVN has a capital markets group as well that's run by a gentleman named Gabriel Silverstein that puts together some pretty good debt structures for us on portfolios. But they're typically, not drastically different than commercial, except the rates aren't quite there yet because Freddie and Fannie don't play in the existing, debt space right now. They did for a little while. I suspect that they'll be back because the space is becoming more and more popular, but they kind of dip their toes in on the affordable side of things, but they've since pulled back. But, we're seeing, 70, 80, 85% loan to value, 5.5% interest rates, everything else pretty typical that you would see.
Non-recourse or are there non-recourse?
You can get non-recourse. Yeah. Again, it depends, oftentimes on the borrower's strength, but there's definitely some non-recourse, debt out there as well.
Is the CMBS world, are they playing in this niche yet?
They are a little bit. I haven't seen it that much, but yeah, they're there.
Okay. Got it. There's a couple more questions I have, but I want to make sure that we don't gloss over the, build for rent business model and what that really is. Again, there's a few more questions I have, but they all kind of tie in together anyway. So if you could, for those folks that aren't aware of what build for rent means, maybe give us a little bit of a background and definition on it.
So there's really 2 distinct models in build for rent, and one has kind of been pioneered here in Phoenix and not the one that we really focus on, which is really what is a horizontal apartment complex where a developer builder is building detached units all on one parcel. So maybe it's 150 units. You got a 600 square foot 1 bedroom, an 800 square foot 2, and a 1,000 or 1,100, 1,200 square foot 3 bedroom unit, but they're all one parcel. So just like an apartment building, the landlord pays water, sewer, trash. You've got common area, utilities, heavily amenitized, but again, everything is on one parcel. I consider that an apartment complex. What we really focus on build for rent is what we consider, true single family subdivisions. Every home is fee simple, and has its own deed, its own parcel number. And these communities can be anywhere from, a small 20 home subdivision all the way up to a 350 home subdivision. I think our largest is a 435 home community that's going to be a potential build for rent deal. But typically they average plus minus 100. We work with a lot of the publics, a lot of regional builders all over the country. It's a new asset class. It's actually kind of interesting because it's not new if you think about how, things cycle, whether it's music, fashion, everything is cyclical in life. Pre-1968, builders would build communities and homes for rent all the time. And Ginnie Mae, when they initiated the mortgage pass-through certificate in '68, which eventually, grew to the securities debt market, there was a distinct bifurcation around 1970 where home builders built for sale and apartment developers and builders built for rent. And now 50 years have gone by and things are coming back together where the demographics are changing and the evolution and stigma on renting are not what they used to be. Mm-hmm. And you've got the three largest age demographics in the country, which are millennials, Gen Xers, and baby boomers, willing and preferring to rent in very big numbers. So, having a community of 100 new construction homes built for rent is a very attractive option, whether you're a millennial, Gen Xer, or baby boomer, for all different reasons. A millennial might not be able to put the down payment down. So they might be a young couple with a dog and plan on having a kid, and they don't want to live in a 2-bedroom apartment, so they want a 3-bedroom home. Or you've got the baby boomer that's, kids are out of the house, they don't need a 5-bedroom or 6-bedroom home anymore, and they want to be, a little, they don't want the cost of ownership anymore. You can't buy homes and generate a lot of equity today, by and large across the country, and that cost of ownership is a burden. So why not have a lock and leave mentality? And so it's a really unique, risk mitigated, nice cash flowing asset. And it actually operates more efficiently than multifamily because you've got your tenants on fee simple homes. You've got your tenants paying water, sewer, trash. They pay their electric, their Wi-Fi, their cable bills. So if you don't have a heavily amenitized build for rent community, let's say it's 75 homes, you probably don't need a pool. Maybe a little open area on the dog park, which is basically your retention area, just like any home builder has. And, outside of that, you get some property management, you've got taxes, insurance, there's no HOA expense if you control all the homes in the community, and you get very long-term, quality tenants, that are there for the schools, for the jobs. And typically the rents are higher than an apartment unit because, it's a larger home. Might not be as high price per foot, but the total dollar volume is high. We see on average, people renting for 3.5, 4 or 5 years. I've talked to some build for rent developers that have been doing this for a while. And a recent quote I heard from one said 30% of his tenants have stayed for 9 years when he's built some of these communities, back in 2009 and 10, and he's still got original tenants in some of them. But, that's because they're moving into new construction homes, and, maybe they had planned on moving out at some point when they could afford a home, but maybe the prices got to a point where it didn't make sense for them to buy. And it was just easier to live that lifestyle of not having to worry about the cost of ownership, and something goes wrong, call the landlord. But in new construction homes, there's really no CapEx for 5, 7, 10 years anyways. What's going to go wrong in a new home?
Yeah, very interesting. So I would assume, I was going to ask the question of, are there any restrictions for for the owners of those homes to, if they wanted to exit out of that investment to turn it into a owner occupied unit? But it sounds like these entire communities are being built and sold to one individual. So like there's one ownership entity that owns the entire community. So there's no individual, there's not the developer coming in and selling one by one as turnkey, essentially brand new units. These are all large, entirely owned subdivisions.
That's typical with the buyers that we work with, but it's not 100%. So, sometimes, developers, builders might offer to investors, the first 20% of the community to be sold to an investor, or maybe the last 20% of a community.
Got it.
So it's mix and match. I'm a huge proponent for investors of buying the whole community, because I think from a liquidity and stability and risk mitigation standpoint, it looks better than any CRE asset class I've ever worked on or studied in my life. You don't have, and this goes for single family existing portfolios as well, but when there's a market downturn, the single family world, not only, and there was a graph I was looking at just the other day that went back to 1968 all the way to today, that single family renters average vacancy over 50 years was like 4%. Mm-hmm. You don't see that in any other real estate class when markets, fall. Multifamily, everybody's, moving to the next, moving up a block to the next, better building with a cheaper rent, or, office tenants are jumping from a C class office to a B because it's, they can now, or they're just not even renting office space anymore. Yeah. So you don't see the issues in down markets in the single family world. So, if you own a build for rent community and there's a market correction and people are losing homes, your rental demand just went up. Same if you own an existing single family investment home somewhere. It's much harder for people to jump ship out of a 4-bedroom home, and find something more affordable a few blocks away. So they stay. So your rental demand stays strong. So even if values go down a little bit, what we've been studying and noticing is that, and it's been proven that your rents actually stay stable and or continue to increase, while everything else in the CRE world, it tends to be falling. It's a very, very risk mitigated asset class that, the world is catching on to. I mean, the Wall Street groups have proven it, and the mom and pops of the world have been doing it for 30, 40 years. But the CRE world is just starting to recognize, how valuable it is to own this type of rental asset.
Okay. I know you've already given some comparisons to multifamily, but I guess I'd like to hit on that, really the topic of, not necessarily just build for rent, but just generally speaking, a single family rental portfolio versus a multifamily property. If you had 100, and I'd rather use the single family portfolio, not the build for rent new stuff that's all kind of clustered together. Mm-hmm. 100 doors of single family properties that are, maybe within an MSA, maybe a couple MSAs scattered about a little bit. That's probably a better example to use. If they're scattered about a little bit, you lose some efficiencies there. Compared to a 100-unit apartment complex in that same market, why would an investor consider those 100 single family homes when there's many more perceivable inefficiencies that exist with the management side versus just buying, 100 doors underneath just a few different rooftops?
Right. And it is a perceived inefficiency. It's really not. I mean, if you're a multifamily investor, you're going to have a little bit of a learning curve, something that we help out with because we have all the Alliance support members within SFRhub to introduce. So, if you need a property management company that plays in the single family world, we got it. If you need a master insurance policy provider that plays in the single family world, we have it. If you need general contractors and unit turn groups, repairs and maintenance, we can turn over all the necessary tools for you to have the team to help operate the single family portfolio. But the biggest inefficiency in the single family world compared to multifamily is that, when there's issues, the homes are scattered around, and you do have more rooftops than one building or two buildings, all in one spot. But on the flip side, you have typically greater appreciation in good markets because single family homes appreciate at a higher rate than a multifamily apartment building typically does. You also have the stability of the longer tenant tenure. So your unit turn cost isn't as often. Typically in an apartment building, you're turning over 50% of the units a year. In a single family portfolio, you're in that 20 to 30% turnover a year. So, those types of apples to apples comparisons really start making a difference when you own a single family portfolio because you're gaining longer term tenants, you're gaining the less repair and maintenance from a turnover standpoint. It averages out to greater cash flow in the long run. And again, when there's a market turn, your rents actually go up in the single family world. So you don't have to worry about handing out concessions and losing tenants, in downturns. So it's again, just extremely risk mitigated, very stable asset class.
Mm-hmm. Got it. I will tell you that this is not to debate your point there, but I owned a couple hundred single-family properties here in Southwest Florida when the recession hit, and we actually did. We had a little bit of a rental issue down here. A lot of it was folks moving out of the area. We had a exodus for a couple of years of folks moving out of Florida. A lot of real estate trades. Obviously just shut their doors. So there was a period of time where we struggled a great deal with our single family home portfolio where we actually had to give concessions. I know that it's a little bit of an anomaly. There was another factor involved there as well. There was lots of rooftops built, for a population that wasn't yet here, tens of thousands of homes that were just being built nonstop down here in Southwest Florida, which ultimately those builders started renting out those units when they realized they weren't going to be able to sell them. And so we also had some there as well as a lot of that kind of an anomaly.
That makes sense. That makes sense. And Florida is unique comparatively to most other areas in the country. So that makes a lot of sense. I mean, when you're overbuilt, which Florida seems historically to do pretty well, that, those are the types of issues that will arise for sure.
Yeah, sure. Well, Michael, this has been an absolute pleasure. Lots of great information shared here today. And what I'd like to ask of you as we enter into the Golden Nugget segment of the show is, obviously, you've shared a ton of golden nuggets already, but if you had just one final golden nugget of advice or wisdom that you can leave with our listeners today that may inspire and motivate them as they progress in their real estate investing career, what would that one last golden nugget be?
I'll stick to the single family world specifically, but I would just say, get in it. Whether or not it's a smaller build for rent deal, it's a great opportunity to buy build for rent at a discount to retail because it's beneficial for the builder to be able to sell to one group and build them all quickly and the buyer operator rent them, or if it's an existing portfolio, be strategic, be smart, but get in it, get your hands wet. I think that this space is young. I mean, everybody in the space believes that, but it's really in its infancy. Mm-hmm. And there's 30, 40 years of runway in the single family rental space. So I think just getting into it is the best advice that I could give because the opportunities will continue years to come.
Yeah, no, that's great. I mean, simply put, take action, and whether it's getting involved in the portfolio side or any other type of investment. I mean, obviously do your homework, do your due diligence, but ultimately you got to take action. Lots of folks listen to these podcasts, my podcast, the hundreds of other real estate podcasts out there, and they do it, for months and for years and ultimately never actually pull the trigger on anything. So I think that is the important first step, right? You got to build some momentum, make a decision,
you got
momentum and move forward.
You got to build momentum. You got to build scale. No different than investing in anything. The better you understand the asset class, and the more that you know your markets, and the more that you have in the market, those economies of scale of operating, you start hitting those efficiencies. So it's the same.
Yeah, absolutely. Well, Michael, this has been an absolute pleasure. Really appreciate you joining us here on the show. Mm-hmm. And folks, to learn more about Michael and his, you can go visit his website. It's SFRhub.com. Again, SFRhub.com. And Michael, that's all we have, my friend. Thank you again.
Hey, thank you.
Congratulations. Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.